Marc Faber is editor and publisher of the Gloom, Boom and Doom report, and he joins us now on a camera. Mark, great to have you back on the programme. Look,
yes, thank you.
It just doesn't get any better, does it, at the moment? Give us your latest thoughts on when we see stabilisation in both the credit and equity markets.
Well, I think we have reached extreme points in the sense that asset markets are, by and large, terribly oversold, whether these are gold mining shares or commodities or equities. On the other hand, we have an overbought US dollar and overbought US Treasury bonds. So I think that volatility will continue, but what you could get within the next 3 months is a very strong rebound in asset markets, in equities, and a sell-off in bonds, and eventually a sell-off in the dollar.
Catalyst for that, Mark?
I beg your pardon?
What will be the catalyst for that? Because that will be some significant turnaround on the current flow.
Yes. I think the key really is to understand that there has been a huge wealth destruction in the private sector, but at the same time governments around the world and central banks around the world are supplying liquidity into the system and boosting their fiscal deficits. So at some stage I would imagine that these liquidity injections will have an impact on asset markets and support them and actually lead to rallies that are stronger than people expect, because don't forget, a lot of financial institutions have now liquidated their equities and sit on very considerable cash. At the same time, if you have cash, there's practically no return on cash. If you have it in safe cash, which is treasury bills or government paper, what is however yielding very high returns at the present time are corporate bonds. And I suppose that not every company in the world will go bankrupt, so in the corporate bond market there is probably some very good value at the present time.
Mark, last year you were very keen on gold and also agricultural land, particularly in China. Have the events of the last 12 months made you reconsider that, or would you still be buying them now?
Well, I still like gold simply because it's a cash that is not the liability of someone else. What disturbs me a little bit about gold near term is that it's one of the few assets that has held up very well. And if you get a very strong rebound in equity markets, it is conceivable that people will then sell assets that have held up well and park their money in distressed assets, in other words, in US stocks, in emerging market stocks and so forth. There's one sector in the gold sector which has sold off very dramatically. These are gold mining exploration companies. They are at extremely depressed levels, and I would imagine that even if the gold price went down somewhat, these exploration companies could actually rally.
And what about agricultural land?
Well, I prefer agricultural land to properties in financial centres. That should be very clear. I don't think there's a huge downside risk in owning land in agricultural regions, whether it's in China or in the rest of Southeast Asia or in Argentina. Some of the agricultural related companies, you take for instance in Argentina Cresud, which owns farms in Argentina and other Latin American countries. It was in 2002, 2003, during the Argentine crisis, around $5. Then it went to over $20. It is back at $5. So it's very, very low valuation at the present time.
Mark, speaking of which, it's Louisa, by the way. Hello. What are you basing your valuations on? As in, everything is fundamentally kind of changed at the moment, or fundamentals may be the same in and of that we're looking at hard times, but we can't value it in ways that we're used to doing. So how do you put a value to anything?
Well, that's a very good question, because if the whole world collapses, then obviously book values will be very different than what was perceived them to be until a year ago. And as I mentioned, we had this huge wealth destruction. But I would imagine that, as I said, the liquidity injections by the governments, and don't forget, if markets continue to sell off, there will be more capital injection and more liquidity creation. And one day, it will trigger a huge rally where people rush out of cash into assets because they will become not concerned about deflation, but concerned about the monetary impact of this liquidity injection on asset prices. And so they'll rush into hard assets, whether it's land or raw materials, in particular gold, or real estate in